Welcome to Global Trends. Please subscribe and hit the bell icon for more breaking updates. A sudden and dramatic shift in American trade policy has sent shockwaves through the nation's economic landscape, catching many by surprise and leaving industries scrambling to adapt. Nowhere has the impact been felt more acutely than in the global automotive industry, where giants like General Motors are facing an unprecedented financial storm. The uncertainty has rattled investors, shaken boardrooms, and left employees wondering about the future of their jobs. The Trump administration's newly imposed tariffs specifically target foreign-built vehicles and imported components, upending the complex international supply chains that modern car makers depend on. For decades, automakers have sourced parts from around the world to keep costs down and quality high, but these tariffs threaten to unravel that delicate balance. For General Motors, this policy change was nothing short of seismic. The company was forced to reevaluate its entire financial outlook, reconsidering everything from production schedules to long-term investment plans. Executives faced tough decisions as they tried to navigate this new and uncertain terrain. The company soon announced that it could face potential profit losses of up to $5 billion, a staggering figure that represents a fundamental threat to its stability and future growth. This loss isn't just a number on a balance sheet, it has real consequences for workers, shareholders, and the communities that depend on GM. In response, GM had to quickly revise its profit forecast, sending a clear signal to the market about the severity of the situation. The company's leadership scrambled to find ways to cut costs and preserve cash, knowing that every decision could have far-reaching effects. The financial pressure became so intense that GM was forced to halt production at several plants across the country. These shutdowns were a direct result of the immense strain caused by the tariffs, and they left thousands of workers facing an uncertain future. Meanwhile, consumers, fearing that car prices would soon skyrocket, rushed to dealerships in a last-minute buying frenzy. This surge in demand provided a brief and temporary boost to sales, but it was clear that the underlying problems remained unresolved. Ultimately, this wave of panic buying only underscored the deep anxiety gripping the market. While it offered a short-term reprieve, it did nothing to address the long-term financial crisis facing General Motors and the broader auto industry, which now must find a way forward in a dramatically changed environment. The recent turmoil in the auto industry can be traced back to a series of executive orders issued by President Trump, which have sent shockwaves through both domestic and international markets. These orders represent a significant shift in U.S. trade policy, signaling a new era of economic nationalism and protectionism. At the heart of the controversy is a sweeping 25% tariff imposed on all foreign-built vehicles and imported auto parts. This move was designed to make imported cars more expensive, thereby encouraging consumers and manufacturers to favor American-made products. The administration's stated goal is to revitalize the U.S. auto industry by shifting production back to American soil. By doing so, the hope is to create thousands of new jobs, boost local economies, and reduce the country's reliance on foreign manufacturing. This approach is rooted in the America First philosophy, which prioritizes domestic industries and seeks to make U.S. production more competitive on the global stage. The administration believes that by supporting American workers and companies, the nation can regain its manufacturing edge. However, this policy is not without risks. It's a high-stakes gamble, as the administration is betting that the long-term benefits of a stronger domestic industry will outweigh the immediate costs and disruptions faced by businesses and consumers. To ease the transition, certain exemptions have been put in place for vehicles and parts with a high percentage of domestic content. These exemptions are intended to give automakers time to adjust their supply chains and manufacturing processes. Additionally, companies that pay the new tariffs may be exempt from some previous duties, offering a small measure of relief. Still, the challenges for automakers remain significant, as they must navigate a rapidly changing regulatory landscape. General Motors, in particular, has been hit hard by these tariffs. Many of GM's most popular vehicles are assembled overseas, making them subject to the full force of the new import taxes. The policy directly challenges GM's global business model, forcing the company to consider expensive and complex reorganizations of its manufacturing and supply networks. As a result, GM faces mounting financial pressure, with stock prices fluctuating and executives scrambling to adapt to the new reality. The need for rapid change has left the company exposed to significant risks. For GM's workers and management alike, the impact is profound. The company's existing business model is being tested as never before, with uncertainty looming over jobs and future investments. Ultimately, the tariffs have set in motion a costly and complicated reorganization of GM's operations, the effects of which will be felt for years to come as the industry adapts to a new and uncertain landscape. The financial impact of tariffs on General Motors was both immediate and deeply unsettling for the company. Practically overnight, GM found itself grappling with a new economic reality as the costs of imported materials and vehicles surged. Executives were forced to confront the harsh truth that their carefully laid financial plans were suddenly at risk, and the company's future profitability was in jeopardy. In response, GM slashed its profit forecast by a staggering $4 to $5 billion, a move that sent shockwaves through the automotive industry and Wall Street alike. The sudden increase in costs, driven by tariffs, left little room for optimism as the company's leadership scrambled to adjust their projections and reassure investors. The company's core profit forecast was drastically cut, wiping out expected earnings that had been counted on to fund new projects, pay employees, and invest in future technologies. Assembly lines slowed and uncertainty rippled through the workforce as management weighed difficult decisions. Net income projections also took a substantial hit, signaling a fundamental shift in GM's business economics. Analysts and investors watched closely as the company's financial health was called into question, and the long-term effects of the tariffs became a major concern. A significant portion of these losses was directly tied to vehicles imported from South Korea, a key manufacturing hub for GM. The tariffs made these imports far more expensive, eroding profit margins and forcing the company to reconsider its global supply chain strategy. Popular models like the Buick Encore GX and Chevrolet Trax, which are assembled overseas and shipped to the US market, were hit especially hard. These vehicles, once strong sellers for GM, suddenly faced an uncertain future as their cost advantage disappeared. GM now faces a difficult choice: either absorb the higher tariff costs and accept lower profits, or raise prices for consumers, which could make their vehicles less attractive compared to competitors. Each option carries significant risks for the company's market position and long-term growth. Raising prices could easily drive customers to rival automakers who are less exposed to tariffs, leading to a potential loss of market share. The competitive landscape in the auto industry is fierce, and even a small price increase can tip the scales. The brutal financial logic of tariffs has had a swift and negative impact on GM's bottom line, forcing the company to rethink its strategies and brace for a challenging road ahead. Tariffs have led to direct consequences on GM's factory floor. GM confirmed production halts at several plants to control costs. These shutdowns affect the entire supply chain, leading to potential job losses. The decision to idle plants has far-reaching economic consequences. On the showroom floor, tariffs triggered a short-term buying frenzy. Consumers rushed to buy vehicles before price hikes, distorting market figures. April sales figures look impressive but may be followed by weaker sales. The boom and bust cycle creates instability for dealerships and inventory planning. The short-term sales gain doesn't solve the underlying problem of higher vehicle costs. Tariffs impact GM's workforce, affecting profit-sharing bonuses. Bonuses, linked to financial performance, will see substantial reductions. Profit-sharing checks are significant for workers' annual earnings. The reduction in bonuses is a direct financial hit to workers' budgets. White-collar employees will also feel the pinch as performance-based rewards shrink. The situation demonstrates how macroeconomic policies impact individual workers. Reduced bonuses remind employees of the interconnectedness of trade policy and financial security. GM is not standing still, formulating a strategy to counteract tariff effects. The goal is to offset cost increases through self-help initiatives. A central pillar is increasing U.S. production to avoid import taxes. GM plans to boost production of profitable trucks at its Indiana plant. Increasing U.S.-made content in vehicles is another critical focus. GM works with suppliers to ensure compliance with new rules. A company-wide cost-cutting program is implemented to preserve capital. CEO Mary Barra confirms ongoing dialogue with the Trump administration. GM's strategy is a proactive response to survive and protect profitability. The tariffs cast uncertainty over the entire automotive industry. Stellantis withdrew its financial guidance, highlighting market instability. Ford reported a sales increase driven by pre-tariff consumer rush. All automakers face challenges from the 25% tariff on imported parts. GM's strategy to increase U.S. production is logical but costly. The company plans significant capital investment to adapt to the new landscape. The industry's transformation is driven by technological change and trade policy. Tariffs could lead to higher car prices and reduced market choice. GM's response to tariffs will shape its future and the American auto industry.